So today we're going to look at financial ratios. We have divided them into 4 classifications. The first one is for activity ratios, which gives us information about how well a firm is utilizing its various assets. The second one is liquidity ratios, which gives us information about how well the firm is able to pay its short-term obligations. Solvency ratios give us information about how well a firm is able to meet its long-term obligations, and also they tell us about the firm's financial leverage. And then profitability ratios, they give us information on how well a company is generating operating profits from and net profits from its sales. So we'll start with activity ratios. Okay. And like we said, it tells us about the asset utilization. Okay, how efficiently the firm is managing its assets. We're going to start by looking at the receivables turnover, which is annual sales divided by average receivables. Average receivables is equal to opening receivables plus closing receivables divided by 2. It is desirable if the receivables turnover is close to the industrial norm. And then to get our days of sales outstanding, we say 365 divided by the receivables turnover. Okay, this tells us the number of days it takes for customers to pay their bills. It is also expected to be close to the industry norm. And then if it is too high, it might mean that the customers are too slow in paying their bills, which means that too much capital is tied up in assets. Our capital will be tied up in receivables. If it is too low, it means that maybe we're too strict. Our credit policy maybe is too rigorous, which might also hamper our sales. And then we move on to inventory turnover, which we find by saying cost of goods sold divided by the average inventory. And then to find our number of days of inventory or days of inventory on hand, we say 365 divided by the inventory turnover. Okay. It tells us how long it takes for us from the time that we buy our inventory to the time that we sell it. It is also desirable if it is close to the industrial norm. Also, if it is too high, it means that too much capital is tied up in inventory, or our inventory cannot be sold anymore. It's now obsolete. If it is too low, it might mean that we do not have adequate stock on hand, which would also hurt our sales. The same can be done for our payables turnover. We can calculate our payables turnover and then use our payables turnover to calculate the number of days of payables, which is how long it takes for us to pay our creditors. Also, it is desirable for it to be close to the industrial norm. Then we move on to the liquidity ratios. Like we said before, liquidity ratios, they determine how the firm is able to pay its short-term liabilities. And the most common liquidity ratio is the current ratio. We get the current ratio by saying current assets divided by current liabilities. It is the higher the current ratio, the more it is likely that the company will be able to pay its short-term bills. If our current ratio is less than 1, it means that the company has negative working capital, which means that our current liabilities are more than our current assets. And then we move on to quick ratio. The quick ratio is almost similar to the current ratio, except that in the numerator, where we have current assets and our current ratio, we then subtract our inventory. Therefore, our quick ratio is equal to cash plus marketable securities plus receivables divided by current liabilities. Okay, also, it's the same for the current ratio. The higher that this ratio is, the more likely it is that the company will be able to pay its short-term bills. Then finally, under liquidity ratios, we'll look at the cash ratio. Under the cash ratio, we say that cash ratio is equals to cash plus marketable securities over current liabilities. So the higher the cash ratio, the more likely it is that the company will be able to pay its short-term obligations. And then we move on to solvency ratios. We say that solvency ratios measure the firm's financial leverage and its ability to meet its long-term obligations. Okay, and then we'll start by looking at the debt to equity ratio. So the debt to equity ratio is equal to total debt divided by total shareholders' equity. Increases and decreases in this ratio suggest a greater or lesser reliance on debt as a source of financing. So if this ratio is increasing, it means that the firm has a greater reliance on what? On debt as a source of financing. It's using loans, it's using debt to finance its business more than it is using shares. And then we move on from the debt to equity. We also have debt to capital, which is equals to total debt divided by total debt plus total shareholders equity. We also have the debt to asset, which we get by saying total debt divided by total assets. Okay, and then we'll look at the interest coverage ratio. This is also a solvency ratio. So to calculate the interest coverage ratio, we say earnings before interest and taxes divided by the interest payments. The lower this ratio, the more likely it is that the firm will have difficulty meeting its debt payments. So basically here we are measuring how much our earnings before interest and tax can cover our interest payments. Then we move on to profitability ratios. Then we say profitability ratios just measure the overall performance of the firm relative to its revenues, to its assets, to its equity, and to its capital. So we start with the net profit margin, which we get by saying net income divided by revenue. If this ratio is too low, then the analyst should be concerned. We also have the gross profit margin, which we find by saying gross profit divided by revenue. We also have the operating profit margin, which we get by saying earnings before interest and taxes divided by revenue. Okay. Also, analysts should be concerned if this ratio is too low. And then we also find our return on assets, our return on equity. To find our return on assets, we say net income divided by average total assets. And then to find our return on equity, we say net income divided by average total equity. Okay, also analysts should be worried if this ratio is too low. Then we move on to the limitations of ratio analysis. The first one and the major one is that these ratios are based on historical information. We use information from past results and from past financial statements to come up with financial ratios. So it does not necessarily mean that the past will represent what is going to happen in the future. Okay. Also, inflation. These figures, they might be affected by what? By inflation. So if one period is affected by inflation, it becomes now difficult to compare between different periods because of inflation. And also manipulation of financial statements. Ratio analysis, these are based on information that is reported by the company in the financial statements. The problem is that this information might be manipulated, and if this information is manipulated, therefore ratio analysis may not accurately reflect the true nature of the business. Okay. And there are many limitations of ratio analysis, so I want you to come up with more limitations of ratio analysis. Also, I am going to email you questions with figures which you will now have to input and calculate and compute these ratios, okay, so that you practice these ratios. Also, you will be commenting, so you calculate the ratios and you comment on the ratios.